Welcome. I'm Austin Shepard, President and CEO of Fiduciary Trust Company, and we're delighted to have you join us for our 2025 Market Outlook. We had a very busy 2024, and 2025 looks equally, if not more so, active in the investments. And so, here to make some sense of a little bit of the past, but more importantly about the future, I'm joined here with our head of investments, Pat Donlan. Pat, welcome.
Austin, thank you. Thank you for having me.
We're delighted. What we're going to do today is I'm going to turn it over to Pat to walk through a series of slides and market commentary, and then I'm going to come back with a few highlight questions and a little bit of a dialogue. So with that, over to you, Pat.
Thank you, Austin. So we'll start off with a quick review of 2024 and the fourth quarter across major asset classes. So for the full year, returns were positive across pretty much all asset classes. U.S. large and mid-cap stocks were the best performing for the second year in a row. And the Mag 7 stocks led the way in U.S. large and mid-cap. They were up 67% for the year. For the fourth quarter, U.S. large and mid-cap was the only major asset class to outperform cash. And there were really two big market-moving events in the quarter. The first, of course, was the presidential election. And most risk asset classes rallied in the immediate aftermath of the election. But the second big event was the Fed's December meeting, and risk assets basically gave up all of their post-election gains after that meeting. And what happened there, the Fed did end up cutting rates 25 basis points, just like the market was expecting them to. However, they released new economic projections that showed a more gradual rate cutting cycle and a higher terminal rate. They were a little more concerned about inflation has been stickier than they expected. So that repricing of the Fed's expected rate path meant interest rates moved higher during the quarter, and then investment-grade fixed income and muni bond prices were down. Actually, both asset classes experienced negative total returns for the quarter. But the worst performing asset classes in Q4 were non-U.S. equities, so developed market and emerging market equities. Both posted high single-digit declines, almost all of which was due to currency fluctuations. So their currencies depreciated against the dollar. For example, the MSCI EAFE index was down 8% in US dollar terms. It was only down about 50 basis points in local currency terms. So now we'll turn to 2025, and maybe a good place to start is with the US dollar. So the fourth quarter showed us, obviously, the dollar can have a significant impact on asset class returns for non-U.S. equities. But it's also at the center of Trump's proposed policies around tariffs. So Trump has said he believes that excess dollar strength is hurting U.S. export competitiveness. It's caused our large trade deficit, and it's led to the loss of manufacturing jobs in the United States. Whether that's all true or not is really up for debate. Some economists disagree, but he's certainly made it clear that he'd prefer a weaker dollar. So if we just look at some of the facts here, it is true, he's correct, that the U.S. has run persistent trade deficits going back more than 20 years, which just means we import more goods and services than we export. And it's also true that the dollar has appreciated significantly in the last 20 years. It's not quite at, but very close to 20-year highs at the moment. And then if we want to determine whether or not the dollar is overvalued or undervalued relative to other currencies, we can look at something called purchasing power parity, which basically tries to put two currencies on an apples-to-apples basis. And if we look at the dollar on a purchasing power parity basis against other major currencies, we see that it's significantly overvalued relative to all major currencies aside from the Swiss franc. So the dollar is certainly very strong right now, but what's less clear is whether or not tariffs will do anything to help that. Many would argue it'll actually do the exact opposite. So Trump believes tariffs will help close the trade deficit, as it's going to make foreign goods more expensive for U.S. consumers, so they'd prefer to buy goods that are manufactured here in the United States. But if we have fewer imports, that also means fewer dollars going abroad to acquire foreign currency that's needed to purchase those foreign goods. And so there'll be fewer dollars in the foreign exchange markets. A lower supply of dollars means a higher dollar price. If we look at back in January of 2018 was the first round of tariffs on China. From that point until the end of the year, the dollar index was up about 8%. So the first round of tariffs, we saw dollar strength after that. And we saw previously that the US ran a trade deficit in 2018 and has every year since. So the tariffs really didn't help close the trade deficit either. And the reason is that dollar strength, that the appreciation in the dollar against foreign currencies kind of offset that impact of the tariffs. So we think a lot of the policies that Trump has proposed are likely negotiating tactics, and ultimately, what gets implemented will be something a little less extreme, and not just as it relates to tariffs, but also immigration. And some of the immigration policies he's proposing, if implemented, are widely believed to be inflationary. And so, if we're right about the fact that the tariff policies and immigration policies will be pared down, it's likely that inflation expectations in the United States will come down, and then actual realized inflation will be lower. And so the Fed will ultimately be able to cut rates maybe 3 or 4 times as the market was originally expecting prior to that December meeting, rather than the 1 or 2 cuts that the market's currently pricing in. And so it's good to remember in the short term, currencies tend to follow interest rate differentials. So the difference between what you can get on a US 10-year Treasury, for example, versus a German 10-year. And US interest rates have moved higher than Europe's, where the ECB is expected to deliver 4 rate cuts in 2025 versus just one in the United States. So if we look at the dollar euro cross plotted against the interest rate differentials between the United States and Germany, we can see they've basically moved in tandem for the last year. And so we think this shows if Trump truly wants a weaker dollar, the way he can achieve that would be kind of paring back some of his proposed tariff policies and immigration policies. And a weaker dollar, all else equal, would be a tailwind for non US equities. So we've talked a lot about the trade deficit, but another big story for 2025 is the fiscal deficit. So in the short term, the fiscal deficit helps boost economic growth, but higher deficits also mean more treasury issuance at a time when the debt to GDP stands at about 100%. And prevailing interest rates currently across the yield curve are higher than the current weighted average cost of debt on the existing debt. So the interest on the debt today is about 4% of GDP. That's near all-time highs. The all-time high was back where we last saw these levels back in the mid-90s soft landing period. Uh, but President Trump has created the Department of Government Efficiency, or DOGE, whose goal is to slash federal spending and cut the deficit from about 6% today to hopefully 3%, which would require something close to about $1 trillion worth of spending cuts. And if we look at the entirety of the federal budget, we can see it's going to be pretty hard for DOGE to hit that target. So they can't really cut mandatory spending, at least not without creating a lot of political turmoil. We don't think they want to cut defense spending. And so all that's left is non-defense discretionary spending, which totals about $950 billion per year. So even if they were able to cut the entirety of non-defense discretionary spending, they'd still come up just short of their target. But that category includes things like essential infrastructure spending and veterans benefits that we don't think they're likely to go after. So we think maybe a more realistic target for DOGE spending cuts is something along the lines of $100 to $200 billion per year, which would only cut the deficit by about 0.5%. But that said, even if DOGE fails to hit their deficit reduction goals, it's possible they can identify ways to make government expenditures more productive, cut wasteful spending, so you get more than a one-for-one boost on GDP on that government spending. Finally, productivity is one of our other key themes for 2025. So aside from cutting spending, the other way you reduce the debt to GDP ratio is to simply grow GDP faster than the debt is growing. And one way to grow GDP without increasing inflation is if you can get higher productivity, meaning you just get more output for the same amount of hours worked. And we think it's possible the US could experience a productivity boom from artificial intelligence, similar to what we saw in the late 90s and early 2000s, after the creation and adoption of the internet. So today, Amazon, Google, Microsoft, and Meta, just four companies, are planning to spend a combined $300 billion to build out AI data centers and train large language models. So uh, we think it's very likely that that'll lead to high productivity gains across multiple sectors. And if you look at the worrying forecast that the Congressional Budget Office puts out that shows debt to GDP ratios in the future rising to 120, even 150%, in those forecasts, they're assuming just around 1% productivity growth per year. We think that could be something more like 2.5% per year, again, like we saw in the early 2000s. And if you look at what we've experienced in this current period compared to the pre-pandemic period, we've already had much higher productivity. In fact, the last 5 quarters, we've seen productivity growth over 2% per year each quarter. So productivity is an important metric we'll be watching in 2025. If we can have productivity consistently above 2%, we think that really makes the deficit a lot less concerning. And finally, in closing, we'll look at positioning going into 2025. We're overweight US large and mid cap equities. Specifically within US large and mid, we like bank stocks, which we think will benefit from fewer regulations under the incoming administration, and also a steeper yield curve, which should help expand net interest margins and profits for banks. We also like certain areas within structured credit where you can get higher absolute yields and wider spreads than you can find in areas of the corporate fixed income market. So that's our view on the markets for 2025.
Thank you, Pat. I appreciate that overview. And as I mentioned, I thought we'd have a few questions. And today I'm going to do something a little different than we normally do. We're going to do number association. And based on that, we'll follow up with questions. So my first question is a number association, $720 billion. Now, do you know what that associates with?
I know exactly what that is. That's the Treasury General Account.
All right, so my question is the TGA, which my sense is that most people who are watching this have not versed themselves in the TGA, the Treasury General Account. Yet you mentioned it earlier as having a potential material impact on the markets this year. And can you talk just a little bit more about its mechanics, how it works, and why we think it will play a factor, at least in the first part of the year?
Sure. So really there's kind of two components to our thesis here, and one's the TGA and the other's the debt ceiling. So the debt ceiling was reinstated starting January 1st. And what that means is the Treasury can't issue any net new debt. Okay. So any debt that comes due, they can roll that over, but the supply of Treasuries is fixed so long as the debt ceiling limit has been reached.
Okay.
And the TGA. So the TGA, what it is the Treasury's checking account at the Fed. So it actually sits outside of the banking system. It's not held at commercial banks. It's held at the Fed. And so as the Treasury issues debt or collects tax payments, it gets built up. And then as they pay the government's bills, it gets spent back down. So it's interest on the debt, Social Security payments, etc. But as that gets spent down, that money hits the system, the financial system, as reserves or cash.
Okay.
And so the way we think about it is at a high level, the financial system basically has two types of assets. There's cash, and then there's non-cash assets, stocks, bonds, etc. And so if the supply of non-cash assets is fixed, at least for a short period of time, there's no new Treasury issuance. We don't expect much IPO, at least in the first half of the year.
There are only so many companies and stock certificates you can buy.
Exactly. So as the amount of cash in the system goes up by up to $720 billion, the aggregate price of the non-cash assets has to come up to balance the system. And so we think it's not at this long-term tailwind, but at least for the first part of the year, as long as those two factors hold, the debt ceiling hasn't been raised or abolished, as Trump has hinted he might like to do, that's going to be a technical tailwind for risk assets.
Okay, so in many ways, it's a little bit of the basics of supply and demand and around the cash liquidity in the system, and this TGA helping come into it will potentially add tailwind or positive actions to prices.
Exactly. And one other thing I should mention, too, is Trump's incoming Treasury Secretary, Scott Bessent, is formerly a hedge fund manager. And his letter to his investors last year, he talked about Janet Yellen using the TGA to goose the markets going into the election. And now she didn't actually end up doing that. The TGA balance really was
Continue to
unchanged.
rise, yeah.
But the fact that he wrote that and
he's aware of it
about that just shows you he's thinking about it strategically as a way to maybe help boost risk assets until Trump's term gets off to a solid start.
I'll be interested. So we're at $720 billion now, and when we get back together in March, it'll be interesting what that level that is. Mm-hmm. All right. Continuing on with my number association for my questions today, I'm going to offer another number, 100,000.
Is that Bitcoin?
It is Bitcoin. So my question relates to Bitcoin and really how 2024 was, again, I don't know whether we categorize as a breakout year for Bitcoin. I guess the question is, given the new administration coming in, how do we think about Bitcoin? Is it legitimatized? Should I go out and buy it? What is our current, or what should people know about it, where we are today?
Well, you're right. 2024 was kind of a game changer year for Bitcoin. We saw the first Bitcoin ETFs get launched. BlackRock's Bitcoin ETF is widely considered the most successful ETF launch of all time. Over $30 billion of inflows into that ETF last year. Bitcoin's price was up 120%. And so that first key event was back in January, the ETF creation. And the second one was the election. Bitcoin got another big bump post-election, as you alluded to, that the incoming administration is widely seen as very pro-crypto. And Trump's actually appointed a crypto czar. That's not an official cabinet position, but it does signal that they are a lot more pro-crypto than maybe the prior administration. So the problem with Bitcoin that we have, and the reason we're not kind of widely recommending that clients add it to portfolios, is we just have absolutely no idea how to value it. And
which is a slight problem.
That is. So you've got to know when to buy, when to sell. And if you can't figure out a valuation for it, from what we've seen, there's really no credible valuation metrics out there. And when we talk to people who are bullish on Bitcoin, the number one thing that we hear is it's got scarcity value, that there can only ever be 21 million Bitcoin mined. And we'll hit that sometime in the next decade. And that obviously resonates. We talked about the TGA and this fixed supply versus the money supply increasing. But we don't think that scarcity value is unique to Bitcoin. And you actually have to look no further than U.S. stocks over the last few years to find a place where, as we mentioned, there's been almost no IPOs since 2021. The largest companies in the market especially have been buying back stock at a pretty breakneck pace. There's over $1 trillion in buybacks in 2024. There's another $1 trillion authorized for 2025.
So the shrinking, the scarcity aspect of the securities, the equity securities continues to do.
Right. Yeah. And Bitcoin, even though there will only ever be 21 million, for now the supply actually does increase. Yeah, not modestly, but it has increased year over year and will continue to do so until it hits that limit. So we just don't think that scarcity value is something you can't find otherwhere in other places in the financial system.
Again, speaking of scarcity, like paintings, right? There are only so many 18th century paintings. You can't get more of them, right?
They're never making more of those. Great point.
But I guess the other component is this aspect of, at least when I buy a stock or, I have a dividend stream, I have ways of evaluating whether there's that stream of income will increase or decrease and so forth. This really, again, back to prior conversations, is sentiment, right?
Exactly. And we'll keep an open mind on Bitcoin, as obviously the ETFs make it a lot more accessible for people like us and our clients. But for now, we just, it hasn't clicked for us quite yet.
Fair enough. I'm going to, I guess, related to that again, the elevation and the inflation of valuations. I'll ask my third and final question associating numbers here, 22.
That's Taylor Swift.
No, try again.
Is that the S&P forward PE ratio?
Correct. So the 22 is the current S&P forward PE ratio, so price to earnings. And that's, I think you're going to confirm, that's a relatively elevated price or valuation. Talk to me, and again, I think this is a good sort of roundup, which is, it seems like all assets, not just U.S. equities, but Bitcoin and others, have high elevated valuations. Is that a point of concern? And how do you think about playing across multiple asset classes where all of them seem to be pretty high?
Right. Right, to that point. So it never feels good to buy something at the all-time high. And the only time the S&P 500 was ever more expensive was during the tech bubble, and that obviously didn't end very well.
Right.
So it doesn't feel good, but as you alluded to, Bitcoin's at all-time highs. Gold's another one that's at all-time highs in nominal terms, very close in real terms as well. Credit spreads are historically tight. So as an asset allocator, it is a difficult time right now, but there are pockets of the financial system like small cap U.S. equities, for example, non-U.S. equities, where valuations are much more reasonable, right in line actually with historical averages. So there are some places you can find value. But even within U.S. large cap, which is typically the largest piece of our clients' portfolios, we'd say that over the short term, valuations don't matter as much as technicals and fundamentals. So for the S&P 500, for example, if we stick with that, from a fundamental standpoint, profit margins have never been higher. The company's generating more free cash flow than they ever have, and we're expecting 10 to 14% earnings growth for 2025. So we're in good shape from a fundamental standpoint. And then there's the technical factors like that $1 trillion worth of buybacks we mentioned, and the TGA and debt ceiling liquidity injection into the system. And so we think, even though it doesn't feel great to buy at these valuations, that technicals and fundamentals trump those in the near term anyway.
I think you also say, again, it's one thing looking at it in a short-term period, but over a longer period of time, you sort of say, okay, this balances out.
Exactly.
Cool. Well, excellent, Pat. I think we're going to have our hands full with a lot to tackle in the coming quarters. And so I appreciate your thoughts and comments. And I appreciate you for joining us here today. If these comments and perspectives resonate with you, or fiduciary could be beneficial to you, feel free to reach out to our head of wealth management, Sid Queller. And otherwise, we expect and look forward to seeing you in 3 months when we touch base and evaluate where we are and the things coming down the pike. So again, thank you for joining us.
The opinions expressed in this material are as of the date issued and subject to change at any time. They discuss general market conditions and trends and should not be construed as investment advice. Any reference to specific securities are for illustrative purposes only and are not intended to be and should not be interpreted as recommendations to purchase or sell such securities. Nothing contained herein is intended to constitute investment, legal, tax, or accounting advice, and you should discuss any proposed arrangement or transaction with your investment, legal, or tax advisor. Copyright Fiduciary Trust Company.